You work. You wake up early. You trade your time. You collect your paycheck. And a significant portion of it doesn't stay with you. It flows to a bank. Not because banks are evil, but because the system is built to make you pay. Consistently, predictably, long-term. This isn't about outrage. It's about awareness. Because if you don't understand how the machine works, you become fuel for it. Debt is not just money up front. It's a contract against your future labor. When you borrow $5,000, you're not agreeing to pay back $5,000. You're agreeing to pay back more using hours you haven't worked yet. Interest is the price of impatience. Every monthly payment is a reminder that a past emotion is being financed by your present effort. You didn't just buy a product, you sold future freedom. The bank never asks for everything at once. It says, just make the minimum payment. Sounds manageable, sounds responsible, but minimum payments are designed for duration. When you pay the minimum, most of your money goes toward interest. The principal barely moves. You're running, but the finish line doesn't get closer. This is how debt stretches from months into years, not through force, through structure. When you pay cash, you feel loss. When you tap a card, you feel convenience. Behavioral research shows that the pain of paying decreases when money becomes abstract. A swipe doesn't feel like sacrifice. It feels frictionless. And frictionless spending increases consumption. Credit limits are not based on discipline. They're based on statistical tolerance for risk. The system knows roughly how far you can stretch before you break, and it prices that risk in. People fear big numbers. They rarely fear percentages. 18%, 22%, 27%. On paper, they look manageable. Over time, they compound. Interest works while you sleep, while you rest, while you struggle, while you lose income. It doesn't pause, it doesn't negotiate, it accumulates, and if your money isn't compounding for you, it's compounding for someone else. A bank doesn't really sell you $50,000. It sells you early access to a lifestyle, a house before full savings, a car above your income bracket, a phone today instead of next year. Debt expands your present by compressing your future. It feels like acceleration, but often it's just reordering consequences. You experience the reward now. You experience the cost later, and later always arrives. This is not anti-debt ideology. Debt can be a tool. Strategic debt can fund an asset, a business, an appreciating property, an income-generating investment. But consumer debt rarely builds leverage. It builds obligation. If the debt does not increase your future earning power, it decreases your future flexibility. That's the dividing line. Asset-backed leverage versus lifestyle financing. One builds power, the other builds pressure. Banks don't rely on hope. They rely on probability. They know a percentage of clients will carry balances long-term. A percentage will miss payments. A percentage will revolve debt for years. The interest rates are structured to cover risk and ensure profit. You are not being targeted personally. You are being modeled statistically. If you don't manage your numbers intentionally, you become part of theirs. When you're debt-free, you negotiate. When you're obligated, you comply. You tolerate bad jobs, you accept poor conditions, you delay transitions. Because the payment is waiting, every month, without emotion, debt reduces optionality, and optionality is the foundation of power. Financial pressure becomes psychological pressure. You stop choosing, you start surviving. Modern economies run on credit expansion. Consumption increases GDP, credit increases consumption. So access to debt becomes easier, instant approvals, buy now, pay later, pre-approved offers. The goal is not to trap you, the goal is to normalize borrowing. And once something becomes normal, it stops feeling dangerous. But normalization does not eliminate risk. It just disguises it. You think the cost is the extra $800 in interest? It's not. The real cost is lost investment opportunities, delayed capital accumulation, reduced mobility, chronic stress. Every dollar sent to interest is a dollar not building equity. Over time, that gap compounds. Small financial leaks become structural delays, and time is the one resource you can't refinance. This isn't about rejecting the system, it's about using it intentionally. A bank is a tool, but tools should extend your leverage, not drain it. Use debt when it builds an asset, it accelerates income growth, it creates measurable upside. Avoid debt when it satisfies impulse, it signals status, it replaces patience. If something requires debt, ask whether it truly requires urgency. Financial power is not a high credit limit, it's low obligation. It's the ability to walk away, to pivot, to wait. It's the absence of pressure. Every paid-off balance increases freedom. Every avoided unnecessary loan accelerates ownership. You don't need to hate banks, but you must understand how they profit. Because if you don't design your financial structure, you'll operate inside someone else's, and their structure is optimized for them. So ask yourself, are you working to grow capital or to service interests? Stop feeding the banks. Start building assets. Start building leverage. Start building freedom. Because the goal is not access to money. The goal is control over time. And time is the only asset that truly compounds.